When talking to clients, it's pretty common to have them probably not understand every single thing you're saying. You try to explain things clearly and you think they're understanding, but are never quite sure if there's a point of disconnect or not, because they oftentimes don't even ask questions. Many come in with their own acumen and are not accustomed to feeling illiterate on a topic, but when they know that they're sitting with you, they're on your turf, and their expertise is subordinate to your own. However, there's one advantage that real estate offers that other investments do not, that I believe really needs to be explained very simply and very carefully to make sure that the light bulb goes off and they have that aha moment, because when they do, they'll be as excited to buy and save up for their next investment property as you are to sell it. So don't worry, it only involves arithmetic at maybe a fifth grade level, so let's just jump right in. But first, if this sounds like a topic that will help you, please like this video and subscribe to our channel. We're new to YouTube and it really helps spread the word that we're creating worthwhile videos. Thanks. Hi, this is Russ from the Neon Bros, where we help keep your pipeline full by educating your everyday clients about investment real estate so you can leave cold calling to others. I believe the greatest advantage investment real estate offers your clients is the assumed use of a mortgage to secure the property. Even just hearing me say that may actually disappoint you, as you were probably expecting me to say something lesser known and more profound. Everyone knows and assumes a buyer will be using a mortgage when buying a property. That's not true in the stock or crypto world, where the assumption is that you can only buy what you have cash to purchase. Using margin on a stock account is far less ordinary to stock investors than using mortgages is to real estate investors. While everyone knows what I'm saying is true, I doubt many have ever explained it to a client in the simple but powerful way I'm about to demonstrate for you right now. I'm going to share my screen now, but before I do, first a word from our sponsor, Opportunities Everywhere, as explained by that handsome devil that is my avatar. Successful real estate agents know one thing: you're only as strong as your pipeline, but keeping it full shouldn't feel like a grind. Cold calls, awkward networking events, and endless mailers might get your name out there, but they drain your time, energy, and enthusiasm. That's why we built Opportunities Everywhere, a smarter, easier way to attract clients you actually enjoy working with. Instead of chasing leads, our system creates them for you. Using a library of short, engaging 10-minute videos, it quietly teaches everyday people how and why to invest in residential real estate. Then, when they're ready to act, they come straight to you. The best part? These aren't just one-time buyers. They're future investors you've shaped from the start, clients who understand your approach, trust your guidance, and keep coming back for their next purchase. If you're ready to fill your pipeline with the kind of clients you've always wanted, visit opportunitieseverywhere.com to learn how. All right, so let's take a look at a really simple example. In this example, we're going to assume that somebody, one of your clients is considering buying a house that's, say, $200,000. Now, anyone watching this from a different part of the country where you can't buy a house for $200,000, just understand that this is reasonable in certain parts of the country, perhaps in the Midwest, and that may be something for you to have to explore. But the numbers are still true. Just maybe add a zero if you're out in San Francisco or in New York or somewhere that's much more expensive than this. But so we're going to just assume that this is realistic for wherever the area is that we're talking about, and the house price that your client is considering purchasing is $200,000. And we're going to assume that it's going to appreciate by about 5% a year, at least in the first year. So this investor is deciding between whether to leverage the property or to pay cash. So if they were going to leverage it, they're going to use 20% down or $40,000 instead of paying all $200,000 at once. So scenario one is to pay cash. So we'll use this as our baseline. So the house price is $200,000. If your client did it, that would mean that he or she put in $200,000 and that his equity is then $200,000. After year one, it appreciates by 5%. So 200,000 times 0.05 equals $210,000. So by the end of year one, the house price is $210,000 and the investor's equity is also $210,000. So that means that the investor's the investor's equity appreciation, and I'm making a distinction here between the investor's equity appreciation versus the home's appreciation. In this case, it actually is the same. It's the same $10,000 increase divided by the original $200,000 price equals 5%. So the investor's equity appreciation is the same as the home's appreciation. Now, going to scenario two, where we use a mortgage, this is a little different. So the house price is the same. It's still $200,000, but instead of plunking down all 200,000 of it, assuming that this person can afford that, we're figuring out what's better for him. So we're saying that maybe let's try on for size a 20% down payment or a $40,000 down payment on this house. So his equity would then be $40,000. After year one, the $200,000 house appreciates by 5%. And so that's the same as scenario one. So that equals $210,000. So the house price is $210,000. But if you notice here now, the investor's equity, which had been $40,000, is now $50,000. So that $10,000, notice that he enjoyed the exact same amount that the home enjoyed, even though he only put in a fraction of the money. So what this is showing is that his equity appreciation is 10,000 divided by his investment of 40,000, which is 25%, not 10,000 divided by $200,000. So his personal rate of return of the amount that he actually put in, since he only put in 40,000, is much bigger than that of the house. And that's something that probably people don't necessarily understand. So the investor would be far better off using leverage and even deploying the remainder of the 200,000, assuming he's got that in cash and was ready to do something with it. The remainder of the 200,000 he was considering investing in one property would be better off being put into four other identical houses and earning 10,000 on each of them for a grand total of $50,000, which is the same 25% on his $200,000 investment. So this example ignores the fact that you do need a little cash on the side and that there's costs associated with taking out loans. But just from a purely mathematical standpoint, even if you were to buy three other houses and leave some cash on the side, that would still be a much better arrangement for him than just buying one house and just getting the same results as the house gets. Here, he can actually get his own money has a better performance than the home does. He's actually leveraging the home to get a better performance. So I think most people have probably never had that explained to them this way. And for that reason, when you start looking at these 25% rates of return, that's spellbinding. I mean, most people are used to CDs or even stocks where they average around 11. So this is far superior to that. Notice that the long-term average in the stock market is about 11%. If the long-term average of real estate is about 5% and it is common to use a mortgage with 20% down, which it is, that means it's pretty common to enjoy about a 25% rate of return on real estate investments. That also does not factor in the tax benefits that apply to all properties, the principal pay down, or any possible cash flow, whether now or in the future. For this reason, purchasing investment real estate using leverage is a far more efficient strategy than trying to wait and save up enough to pay all cash. Not only would your client be forfeiting all the years of earning a 25% return, once he saved up enough to buy the property, he would be suffering with lower returns as a result. Not to mention that if he didn't have the $200,000 and had to save up for it, the price might continue to outpace him so that the same house might then cost more than $200,000 at the time that he had the $200,000 available to him. And he'd be forever chasing his tail. If this information was helpful, please remember to like and subscribe. While 5% is not guaranteed, it's a reasonable normal expectation to have on average for property. Even if it doesn't earn 5%, it is easy enough to calculate what the rate of return will be if your client invests 20% as a down payment. Just multiply the actual average by 5. So if it only earned 3% one year with 20% down, that equates to a 15% rate of return, 3% times 5. And the reason it's multiplying by 5 is because 20% multiplied by 5 is 100%, which would be all cash. So that's why we're multiplying by 5. If the property appreciated by 7%, then your investor's return would then be 35% because, again, it's still 7% times 5, and that's assuming that you're putting 20% down. So the real takeaway here is that no matter how small the client's down payment is, he gets to enjoy the entire amount the property appreciates and have it contribute to his equity. Even if he only puts down 20%, he doesn't just receive the 20% of the equity growth, he receives 100% of the equity growth. And that's the magic behind what I'm saying. When new investors understand that, a light usually goes on, goes off on their head, and they can see that growing their wealth each year by 25% is achievable. Then they can see how quickly and meaningfully their life can change for the better. No one ever wants to go back to earning just single digits in CDs once they know they can get 25% with a mortgage. If you're familiar with the rule of 72, what that does is it allows us to predict how long it will take for money to double at a given growth rate. So if this client's wealth is growing at 25%, then 72 divided by 25 equals 2.88 years. So roughly every 3 years, this investor's money can double. This typically gets clients eager to save for and then buy their next property, and then the one after that, and the one after that. If a client has $100,000 now and starts dreaming about doubling it every 3 years, he can quickly forecast that $100,000 will be worth $800,000 in only 9 years, but only if he buys houses and continues to buy houses to execute the plan. So I hope you see how this short lesson with very simple math can be used as a real eye-opener for your clients and a real incentive for them to buy houses. If you need any help with it or have any questions, please use my contact information below. Try it out. Let me know if you have any success with it. Until next time, I'm Russ from the Neon Bros, wishing you and your clients a lot of success with real estate.